Michael Beresford here, everyone. Welcome back to part 2 of Lending Landscape. As I said in the part 1 WOD, today we'll be looking at two really key things. I guess when it comes to actual lending products out there at the moment. Number 1, cash flow, always key. Number 2, structure, and how those two things have changed in light of the APRA restrictions that have been in place for some time now. Especially since March when things got a lot tougher for us as investment borrowers. So I've got an actual example here. I talked about how in the first video that the difference between interest rates on principal and interest loans and interest rates on interest-only loans was increasing in terms of that discrepancy. This is actually based on particular information from one of the brokers that we deal with. I'm not a licensed broker, so I can't talk about specific loan products. This is general in purpose, general in nature, so that you can understand and actually quantify what the different options mean. At the time of filming, this was based on loan products available from NAB today. Okay, so obviously subject to change, but let's go through it. So these numbers relate to loans of an 80% loan to value ratio or less, and they're based on a $400,000 loan amount. Okay, so obviously repayments will change if the loan is bigger or smaller, but this is based on a $400,000 loan amount. First option is that you have a hybrid fixed and variable loan. So in this case, a 3-year fixed period, a 27-year variable period to make up the 30-year loan term, and it's a P&I loan for investment purposes. Okay, so what is being offered as of today? A 3-year fixed rate at 4.24%, shifting then to a 4.84% for the variable portion. Okay, now again, remember that these actual rates will change over time. It doesn't mean that they're locked in. This rate is locked in for 3 years, but this rate is not locked in for 27 years. Okay, it is variable. What that equates to is $19.65 per month for the fixed period and $2.097 per month for the variable period. So we'll do a comparison, but that's basically what this information is telling us. If we come over to the second option, it's a full variable loan, so no fixed period on a P&I structure as well. And the 4.84% rate is what's on offer for the full 30-year loan term right now. Okay. Then if we shift to a fully variable loan that's interest only as opposed to P&I, then we're looking currently at 5.4%. So as you can see, a good 56 basis points difference there between the interest only and the principal and interest rates for investment lending. Okay, so now if we look at the repayments, as I said, $19.65 and $2,100 or thereabouts for the variable period here. For this fully variable P&I loan, we're looking at $2,108 per month. And on the fully variable interest only amount, we're actually looking at $2,246 per month. So it's going to be a very different concept for most of us to consider, especially some of those of us that are newer to investments and to borrowing. But I guess for as long as we've known, typically the interest rates for investment and owner-occupied, variable and P&I have been pretty consistent. Some of the more mature investors amongst us, I definitely remember it from my parents, will remember back to in the late 80s when there was a differential rate for home ownership and for investment purposes as well. So this is not the first time that we've seen it, albeit it has been a few years since that occurred. So the key thing to realize here is in raw dollar figures, you're actually paying more because of the higher rate to be just on interest only than what you are to actually be slowly reducing this $400,000 loan amount on a P&I or P&I loan fully variable or P&I loan with a fixed and variable component. Okay, now it's not always as simple as what's put here. Okay, so this is not a recommendation to shift away from interest only to P&I. It's just something to consider and give you some insight into what's happening in the market. Okay, let me reinforce that. Because as investors, due to the tax benefits that we're able to gain, then this additional interest here is tax deductible. Okay, now remember, the number one reason why we're investing is to achieve capital growth and compound growth. It's not purely for a tax deduction. However, it is a consideration that we need to factor into understanding what the holding cost is for our properties and what the options are and the real dollar terms of those options for us as investors. Okay, so there's a snapshot on cash flow, and at this point in time today, what some of the offers are out there in the market to use as a comparison. Have a look at your situation, see what might be best suited, talk to your broker as well to see what could be possible and suitable for your circumstances, because the servicing calculators that the different banks use, you obviously need to satisfy those criteria and qualify to be able to look at some restructuring or some additional lending. Okay. Now, the second thing, talking about restructuring, the second thing I want to talk about is loan structures. So for those of you that have been following Open Corp for a while, you'll know that we're really big on avoiding cross-collateralization. And the easiest way to explain that is to basically have the deposit and costs that are taken from an equity loan through a different lender to the lender that has the 80 or 90% loan for the new property. Okay, so nothing's changed there, guys. We don't want to be cross-collateralizing all of a sudden. I can't even say it. But with some of these changes, the ways that the banks are shoring up their business is to have control of funds and require contracts of sale before they will approve an equity release. Okay, so again, it doesn't mean that you need to cross-collateralize, but what it does mean is that with increasing frequency, we're having to use the same bank to fund the equity release as what we are the rest of the investment purchase. Now, that's really important, okay, because just because you're using the same bank doesn't mean that the properties need to be cross-secured. Okay, so if that is the situation that will work with you, probably favorable to be able to have the property, make some money and achieve some capital growth. If you want to see where the markets are at, check out my video recently on the market update. Okay, but it's really important that we keep each property structurally separate. And basically what that means is to make sure that the loan that you get against the new property on the mortgage documents is secured only by that new property. Okay, they're not using the existing property as security against the new loan. So some slight modifications in terms of structure, guys, but the number one rule remains: avoid cross-collateralization wherever possible, and hopefully, do some research, investigate your cash flow situation, and see how you might be able to get a favorable outcome based on the different options out there in the market at the moment. Happy lending.